I've been pretty involved in markets, you could say, for a couple decades. I don't think I've seen that or even read about that being a predominant trade, right? Tech and hard assets together is an interesting combination.
Probably in the last 5 years, maybe 10, right? Markets have shifted wholeheartedly, and a big piece of that is just the influx of M2, right? The money supply. We're in a different type of environment today in 2025 than we certainly were in 2015, and let alone even 2020, right? The beginning of 2020. Block out the noise, eliminate narratives, and really kind of drill down on a process. It can be any variation of a process, but as long as you're consistent with it, and I know, Brandon, you very much are.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey everyone, welcome back to another episode of the Tallix podcast. Today I'm joined by a friend of mine, Robert from Hedgeye. If anyone's familiar with Hedgeye and their process, they kind of were born out of democratizing hedge fund type ideas, analysis, and this type of stuff. Interesting shop that's been around for quite a while. When did Keith start Hedgeye?
2008, early 2009.
Okay. Yeah. Right on the back of the GFC. I got introduced to Keith and Hedgeye and what you guys do over there through our mutual friend and acquaintance, Mike Taylor, who's obviously a big fan of what Keith does and actually used a lot of Hedgeye data, I understand, to help produce the alpha that he did when he was managing one of the largest healthcare books on Wall Street, right? So, there's some interesting validity to at least what you guys are proclaiming to do, right? So appreciate you taking the time to join me. One of the things that you guys do that stands out the most is this framework around what you guys call the macro quads, right? And for the people listening, what they did is they figured out how to, and correct me if I'm wrong here at any point, Robert, but similar to, I almost thought of it when I first was introduced to it. I thought of it as kind of like the all-weather beta idea almost of Ray Dalio and Bridgewater having these quadrants, right? And there's different things that perform well at different times, but you put it in this macro framework that then had a quantitative process to identify what quad you were going to be in. And it would help to essentially time up your trades or your exposures to align with the macroeconomic environment rather than consistently owning, everything, right? And I thought that's interesting. So you guys break it down into four different quadrants, and it's a combination of growth and inflationary pressures, right?
That's correct.
All data driven, right? Like this isn't what does, Robert or Keith sort of, just think or feel or, based on what Trump said this week or something like that. And so it's just a matter of, growth up and inflation down, which is quad one, growth up, inflation up, quad two, growth down, inflation up, quad three, and growth down, inflation down, quad four.
Right.
For anyone that is trying to follow along, like really it's like quad one is Goldilocks. Quad two is generally like things are going to feel great for you, like a little inflation, but probably like things are still humming along. Three is where generally things still might feel okay, but that's where you get the stagflationary kind of environment. And then quad four is like when you feel like the world's melting down a little bit, right? Like it's that deflationary environment. Deflation. For as much as people hate inflation, like deflation is actually like very, very uncomfortable for a lot of people, right? So with that kind of out in the open, like that's the way that you guys kind of view the world. There's all this uncertainty right now, Robert. Like there's, I mean, I've had clients text me and say, "Hey, should we take all these gains this year and lock them in and just kind of sit it out?" Like I'm hearing that the market's way overvalued. It's like what's going on? The media is always telling people like the market's going to crash. The world's going to end here. You've got Trump back on the tariff negotiations with China in a really aggressive way. Like, okay, that's just all sort of noise, right? What's the signal? If you cut through the noise, what's the signal right now in your guys' quad framework? How do you guys kind of perceive the world right now?
Yeah, it's a great question, and I think the big piece there is navigating the narrative, right? So if you don't have a process, or if you're struggling or constantly bouncing around from one narrative to another, it is challenging, and you're going to get kind of whipsawed around. But if you've got a process in place where you're navigating the excuse me, the fundamentals alongside the signals, or in other words, kind of like the capital flows, right? In this day and age, in 2025, and certainly as we move into 2026, those capital flows are of even more utmost kind of importance. And I know you had Mike Green on a couple of weeks ago, and you've had a number of conversations around this topic. But when you're navigating the fundamentals, we'll just stick with that first. What we're seeing is our estimates for Q4 here, as we kind of finish up 2025, is a quad 2. So that would be growth accelerating and inflation accelerating. Now, that inflation acceleration is not as robust. So from a delta or rate of change standpoint, it's not as robust as we've seen in prior years, right? So if you go back to 21 or when we were really seeing rate of change of inflation accelerating quite quickly to the upside. It's kind of just staying relatively flat around 3%. Now it is slight growth in Q4 here, but for all intents and purposes, it's kind of we're estimating around 3%, maybe a slight acceleration up to 3.2 for a short period of time, but basically kind of just around 3, north of 3. Now that's a far cry from the 2% kind of target rate from the Fed, Brendan, as you know, but that's kind of our estimate, right? So we're actually seeing kind of 3% here, kind of staying relatively steady for the next 3 quarters. So Q4, Q1, Q2 of 26, and then on the GDP side of the equation, we're seeing that kind of accelerate here, just slightly on a quarter-over-quarter basis to kind of finish off the year, and then really start to ramp higher as we enter into Q1. So I think the first half of the year of 26, kind of like this next period of time, although things may seem frothy or the valuations are rich, the valuations is a kind of is an ancient science at this point, right? In terms of how much profit or alpha you can really generate from that evaluation. But what I'd say is that these bubbles can remain bubbles for longer than many can say solvent, certainly if you're trying to short them, right? So that's Keith likes to remind everybody that we wouldn't be long bubbles if bubbles didn't keep bubbling. So
Yeah.
that's kind of where we're at right now as we kind of finish off the year. So certainly not financial advice for your clients, but at this point in time, we're not really seeing there's certain aspects within global macro that are starting to weaken or are in bearish trends. The Japanese yen is certainly one of those. Certainly the US dollar yen cross. If you also look at consumer staple stocks, XLP as an example, as a proxy, that's in a bearish trend. Oil, the WTI, crude oil, that's in a bearish trend at the moment, right? So there's certainly things out there where if you need to be bearish, or if you're trying to find things that are not working, that there are definitely components that aren't working. Now, if you flip that around, the areas that are working would be anything that's kind of inflationary, or at least kind of a hard asset, right? So if you look at silver miners, copper miners, uranium miners, you just look at the precious metals themselves, silver, gold, et cetera, et cetera. Those are the areas, any kind of AI. But again, I know that's not a hard asset, but these components that have strong kind of tailwinds behind them, right? And you're getting the capital flows both from a capex standpoint and just flows in general. They're at their sales, and you're seeing new all-time highs in many of those asset classes.
Yeah. Oh man, I had so many
I'm so sorry.
I had so
realized
many
I went a
thoughts, and
little
I'm
long
just trying
there.
to gather my thoughts. Like where do I want to start? The first one that I want to just touch on so that I can move past it is as you were talking about valuations and just being an ancient science. Like I thought back to this idea, a couple thoughts on that. I remember first a couple years ago, I was like 23, and I was listening to Jay Coppell speak, and Jay Coppell goes like, so like valuation's a horrible timing tool. Like, so he said like, recessions are the investing equivalent of like jumping out a window, is what he said. And he said valuation just tells you what floor you're on, right?
Yeah, exactly.
And
Exactly.
but it doesn't tell you that it's not a timing tool, right? It just kind of gives you an indication of when things get bad, how bad could they really get? And then the second thought was around valuation was I was listening to David Einhorn speak at a conference at the New York Stock Exchange a couple weeks ago, and and I believe he made a comment about like, okay, so you have a stock that's trading at 18 times earning, and people say, well, it should be trading at 23 times earning, and he says like, well, why? Well, like it's not even the right metric. It's not even. It is no longer the metric that it even matters, right? Like it just why not 50 times earnings? Why not 15 times earnings, right? Like it's almost irrelevant. And his point was obviously as a value investor, like you should look at the endogenous cash flows and can your return that you're expecting be paid out of those cash flows internally in the firm. But if you're not that kind of deep value investor, then just saying broadly the market is overvalued is really a disastrous kind of thing to focus on, truthfully, right? Like, and then the third and kind of final thought on that whole metric was the old George Soros opinion, right? Like, I mean, most people hate the guy, and for his political reasons or whatever, I can appreciate that, but you can't deny that maybe he's been one of the most successful investors, and he's got kind of the old famous quote, and I'm going to get it wrong from a verbatim standpoint, but it's essentially, when you see a bubble, don't run away, you invest into it, right? You want to invest into a bubble because bubbles keep bubbling, right? And you just want to try to not be sticking around when it goes. And that becomes very tough and challenging as an investor because at the end of the day, what you have to do is time markets. And there's so much stuff out there that says, well, you can't time markets or people can't time markets. And, my true and honest belief on that is you can't time markets if you're a big giant mutual fund, that has, hundreds of millions or billions of dollars under management. Yes, it becomes very tough to time markets, especially on a shorter term basis, but you have mandates to live by. You've got implications of moving, capital markets with your positions, just the time constraints to build or get in or out of a position. That all makes a material difference. And that's the data that people really only have available from a public perspective to measure against. And so I do generally think that markets are actually for a professional that's, really specializing in that or doing that. I think they are more timeable than people sort of give them credit for. And I understand that's somewhat of a fringe opinion maybe, but the data is certainly there to support that. And that's why the finance is the industry that it sort of is, right? But everyone has different goals and objectives, and you can maneuver and change to do that. So like, I just always remind people like, hey, invest into a bubble, but don't get married to the position. And the biggest flaw that I see people do is say, well, like, okay, so you invest into a bubble and 2 years later, and I'm going to use silver as an example because this is so real for people right now, right? Silver's currently kind of breaking out above that historical $50, spot price. And say it goes to like $125 a year and a half from now, right? Or $150 an ounce. I don't know when it stops, right? Like I don't. But what you don't want to do is say, well, oh man, I have all this gain. So as silver breaks down and the signs become a little bit more obvious, man, it's time to walk away from this trade. You can't say, well, I don't want to realize the gain, pay the taxes. You got to make sure that when you're investing into bubbles, you don't let the tax tail begin to wag the dog, right? I think that's the disastrous thing that people can do and get too focused on. There is a time and place to be tax efficient, right? Tax alpha is a great thing, but particularly like if you're investing into bubbles and which I think in some regard, I think we're in probably the early phases of some pretty bubbly stuff. And the other thing that, you mentioned was like AI and in relation to this, there's this interesting play where hard assets are I mean, you'd have like bull market for sure. You almost potentially have to describe it as like a parabolic short squeeze almost, right? Like it's just, and what's interesting is it's such a small market from a market size perspective. It can't absorb that much capital, right? Like it just, I mean, if everyone that owned NVIDIA stock sold NVIDIA and went and bought hard assets, it would just moonshot. Like it's just right. Like if you take the valuation of NVIDIA and inject it into these small companies that are hard asset companies, it would just completely blow things out. I mean, like even if you took it and put it into gold, same sort of thing, and gold becomes very inelastic. But the AI data center thing is totally interesting, and from a fundamental standpoint, right? I was talking to a credit analyst about the concerns with some of these AI data centers and the amount of revenue that they have to actually produce per data center on average to satisfy the debt obligations they're taking on to build the data center. And it's what's interesting is there's such a lack of public credit that the debt they're issuing is being wildly oversubscribed, like 25% oversubscribed on your triple C tranches, which is like the worst, for anyone that's like not familiar with credit, that's like the lowest rung, lowest grade, you're the first one to take the losses, and that's still being 25% oversubscribed. So it's literally coming out at like SOFR plus 2.5, which is, I mean, like that's like what people pay on, like car loans. And so at some point, like, does that potentially blow up in your face? And I think it's easy to sort of point it out and say, hey, at some point, almost for sure. But is that a really painful trade that happens 3 or 5 years from now? And then also with technology, does their dynamics change that, do you have a way to be wrong in that thesis? And I've been thinking through that, but it's interesting to couple the tech build outside of the current macro environment with that hard asset side. It's a really interesting combination to me that I think just has not, at least in my investing lifetime, albeit which is obviously not super long, but I've been pretty involved in markets, you could say, for a couple decades. So I don't know what it was like in the 50s or 60s, but certainly now I don't think I've seen that or even read about that being a predominant trade, right? Tech and hard assets together is an interesting combination.
No, I agree, and I'd say actually. Probably in the last 5 years, maybe 10, right? Markets have shifted wholeheartedly, and a big piece of that is just the influx of M2, right? The money supply. We're in a different type of an environment today in 2025 than we certainly were in 2015, and let alone even 2020, right? The beginning of 2020. So before COVID hit and the money supply really started to ramp higher. But going back to your point, I mean, I think. From a credit quality standpoint, I mean, it makes perfect sense. I think the inputs that are being calculated at the moment, I mean, that's the lever, right? If those data centers can get more energy efficient, right, or at least decrease their costs from an energy consumption standpoint, then covering their debt costs, right, might not be as challenging, right? Or if the AI adoption is even more robust, then perhaps they're able to charge more for their cages, right? So there are a lot of different inputs there, but certainly as you're looking at things right now, and you're looking at that SOFR number and the interest rate that they're being charged, and the fact that it's oversupplied, there's an excess demand for those issuance. It does tell you a lot about the environment that we're in right now, and you're seeing that in even in I call it fixed income, but even like convertible bonds, right? Like it's they're putting out one of the best from our standpoint, the way that we score it in our quantitative system, which we dub Hubble, by the way, because it's the you can see the furthest distance in the universe with Hubble. So we like to try to used some fun acronyms and what have you. But basically, convertible bonds, CWB as the ETF, it's ranked the number one sort of U.S. fixed income exposure. Now one could argue that that's not really fixed income, but at the same time, it is for all intents and purposes how it's classified. But I mean the rest of the kind of fixed income universe is not screaming. Buy me here, right? Whether it's so it is interesting. I mean, folks are trying to get exposures to things that may have longer runways in terms of or hot tickets, right? Like AI. It's like if you put AI. I mean, if I was named Robert AI McGroarty, I'd probably get oversubscribed too. So, yeah, but
it's interesting. Let's one of the things that you mentioned was the currency cross, right? With Japan and the US dollar. And I think that's an interesting segue into I saw it where people there's an interesting macro dynamic where people will think and say, well, the dollar's going to collapse, right? And people say that, the dollar's getting crushed, blah, blah, blah. And I always stop back and I kind of ask this question. I'm like, what does that really mean? What do people mean when they say that? And I think there's this concern people have that really what they're saying is that dollar, the US is going to lose dollar dominance and someone else will take over. And I think really I think that's like what they're perceiving their opinion to be. And I think really what they're meaning is the dollar is wildly losing its purchasing power. And the reason I say that is because the dollar, largely from a fiat currency perspective, it's the saying goes, it's the cleanest dirty shirt in the laundry, right? Like you got to pick one. It's because you need a shirt. You're going to go with the cleanest shirt, in the dirty laundry. And so there's kind of no other alternatives aside from hard assets, right? And I think that's, so their general thesis is playing out. It's playing out in the value of hard assets. I'm going to say excluding real estate here right now. And I've got some additional thoughts on that. Why? But, the fiat currency system is really interesting, but we have seen that one of the things I'll see is a lot of financial advisors, and they do a portfolio allocation according to modern portfolio theory and kind of what I jokingly say, like the CFP textbook says you have to do. And that oftentimes means picking up a lot of, large cap U.S. stocks, some mid cap U.S. stocks, small cap U.S. stocks, developed markets internationally and emerging markets internationally, right? You kind of have those big 5 categories on the equity side of the portfolio, and they get a pretty healthy exposure to all. And what's interesting is they say like, well, DM and EM should have this, higher risk premium over time, right? So if you want to outperform S&P 500, you go down smaller in size, right? So you overweight small caps, mid cap, small cap, and then you overweight international, right? You overweight DM and EM. And, that really hasn't worked out for anyone since like 2006, 7. But in the late 90s, well, and probably not even the late 90s, you probably still got walloped by the NASDAQ in 99, and even early 2000. But in 2001 and 2002, 2003, you're probably looking pretty happy with those allocations. And so all of a sudden this year you have like, okay, international has outperformed. And people are banging their chest on that, right? Like, hey, international is just like, we're back to the lost decade and you got to have international again. And I kind of laugh. I think it's really a misplaced idea. And I think there's 2 thoughts on that is that yes, it has year to date, but if you're watching the trend, it's actually weakening. And so international has actually underperformed since April, since the tariff tantrums. International has underperformed, broadly speaking, right? There's always pockets, but broadly speaking, it's underperformed. And so you got most of that alpha, so to speak, in the first couple months of the year. And what also happened the first couple months of the year is the dollar got smashed. So it's not really that the companies produced a higher result or the multiples of the company really increased. It's just that you own an asset that's not priced in dollars, and the dollar relative to the currencies, the foreign currencies, traded down, right? And did devalue that way. what's your thought sort of on what's going on internationally, in terms of currency and valuation and opportunity set from a global perspective?
Yeah, so many layers to peel there. To be perfectly frank with you, Brandon, but
Yeah.
we'll start with kind of the I guess I think what I'd say is that maybe the crux of it is, um, when you look at large cap, when you really just look at equity markets as a whole, really, whether you're the securities domiciled in the U.S. or Germany or Japan and everywhere in between,
Mm-hmm.
right? We're in a world now in 2025 where it's very globalized, right?
Mm-hmm.
You've got if you look at U.S. large caps, I mean, um, their percent of revenues outside of the U.S. is now, you know 50, perhaps 50-50 for some are 60, whatever. Just, it can be a majority. Some of it's not quite, but it's cresting pretty close, right? I mean, if you look at revenues for Apple, Amazon, Nvidia, you go kind of down the list, right? Those, so that's the US side. And then if you flip it over on the flip side, say Japanese equities, there's so many of those larger cap, quality names that are listed on the Nikkei that that generate revenue in euros, in British pound, in US dollars, right? So it's not the same type of environment as you had back in, to your example, kind of 30 years ago in 1995, when when the world was not quite as globalized, and you weren't receiving kind of, you weren't doing business, or if you were, there was pretty big deals, right? Or like it was a big deal for a Japanese company to say, expand into, the US geographic market, right? So I think we're just, it's just a different ball game now. And that's where, in our opinion, you have to be even more selective as to when you get exposure to certain, developed markets or emerging markets economies, and also, where, right? So which ones are you picking? And so yeah, so I'll pause there and pass it back to you for commentary.
Yeah, I think that's an interesting thought too. Is, hey, do you buy the basket of international, or do you look for the opportunity set, right? And there's a lot of different ways to do that. I think one of the interesting things that I've sort of always thought is, when talking to people, is like, hey, if you're going to invest in, large cap US, I get not wanting to hire an active manager per se, right? Like, go with the cheap beta. If you have, particularly if you have like a expense constraint, right? Like, hey, I'm willing to have my portfolio have X type of expense to it. Then you might be better off like allocating the active management cost to something that's international, right? Like if you're going to invest internationally, right? And say, hey, I want to hire a manager that understands these unique dynamics and, can allocate the capital accordingly, and have the best chance at capturing an opportunity set, because candidly, the international markets just are not distorted from passive flows the same way that the US is, my general belief. But there's also like a lot of macro that goes into, and macroeconomic inputs that go into even understanding these. Like, you can't, it's really tough to go into, well, let me use like India as an example. I've got a friend from India, and he said, man, investing in the US is hard. And I was like, what do you mean? So like, well, in India, you just pick like any mutual fund. It does like 30% a year, and I'm like, well, yeah, like in rupees, and he's like, yeah. I'm like, well, that's the difference, man. Like, what's the inflation rate and value of rupees? Like, is your purchasing power in the US going up by 30% a year? And I don't, like, I'm not an India expert, but I would think like, no, probably not. And so what's interesting is like, in the US, we could invest in those same Indian companies and we'd be like, dude, we're losing money every year. This guy's going like, I'm making 30% a year. And we're like, we don't, man, that's like a really tough investment. It's been really hard. And really, you're investing in the same companies. Just the dynamic difference is the currency in which you view things, right?
Mm-hmm.
And the strength of that currency. So, equity exposure can give you this sort of leverage play on currency, right? But you gotta understand the dynamic that you're taking on there. One of the things that I did find interesting was, like, people say, well, the valuations internationally are so much cheaper,
Mm-hmm.
and I go like, yeah, they are, but like, shouldn't they be? I like, why would I want to invest in foreign companies, expecting them to rise to the same valuation as the US, and one of the things I've like that really changed my paradigm on this whole thing too was I think it's something like 45% almost of the revenue, right? The business revenue of all companies in the S&P 500 comes from international business.
Mm-hmm.
It's from outside the US.
Mm-hmm.
So from this like perspective of like, well, what if the US is in a recession, so the US stock market doesn't do well. Well, like probably the rest of the world's doing really crappy too, is my thought. Like it's probably a really interesting case we made. And that will compress the multiples just as bad. And in foreign, in foreign countries, I don't really see where that is. So it's just, to me, it's sort of, does the dollar break down from here or does the dollar strengthen? And I think what we're seeing right now is the dollar kind of bottoming out and coming into a period of strength, and rotating back into favor here.
It's interesting you bring that up because we actually kind of almost just went through a dynamic like this, Brendan, where at the back half of 24, right? So Q3, Q4 of 2024, the US actually had quad 4 and quad 3s, when you look back historically. Now, they were coming from kind of relatively elevated levels of basically like 3% GDP growth, but they did slow, right? They slowed, and it's all about the rate of change, right? So it's like the delta. Now, some might say, okay, well, the absolute was still kind of above 2, and that is true, right? But it's from like where we were coming from, and so we were kind of slowing in the U.S., but there's a lot of economies globally that were accelerating, right? That whether it be Japan, South Africa, Germany, the Eurozone as a whole, right? They basically throughout 2024 they had 1, 2, and then started the year in 2025 with another quad 2. So, you did have a bit of that dynamic, and I think I would say there's a huge element, right, Brendan, in terms of like U.S. equities should kind of be hit here, but I do think it helped earnings a lot in terms of like you kind of had this sort of an ability by a lot of the large caps to offset some of their kind of revenue weakness or maybe margin compression in the U.S. side of the equation because they were able to kind of recapture that internationally.
Yeah. Well, and what's interesting though is if you look back, like broad international exposure last year in 2024, like didn't perform meaningfully. Like there's no one. I did not meet a single person in 2024 jumping up and down, woohoo, I'm so glad I had half my portfolio in international, and so even though like in those markets, they had quad 1, quad 2, which is like a phenomenal year because the dollar was so strong last year. Right. And the dollar ran up to like, what did it peak out at like the beginning of this year? Like 113, 114.
Yeah. What's around there. Yeah.
Yeah. Like, and so that the dollar strength sort of like worked against you and covered up the gains that you would otherwise sort of have. And I just think that's where, so this year when the dollar got smashed, you have like, and I think this is what you're saying is last year under the surface, you have this great year for international, but dollar strong. And so you had and I say this somewhat jokingly, a lot of stored alpha in international. And so once the dollar receded, right, you could realize that alpha. But
no, I think that's accurate. And but I will say, like, we just saw the dollar or like, DXY start to kind of move up in, put in higher lows and really just turn back to bullish trend. So, couldn't we see kind of a dollar up, stocks up, bonds down environment? Absolutely. Right. I mean, it's possible.
Like you're saying yields down or bond price down?
Yields down.
Yields down. Yeah. So like, and everything up.
Yeah.
And everything up. Right. I mean,
correct. Well,
the interesting thing about that is I actually took up a position from a disclosure perspective here, I suppose. I took up a position in the dollar a couple weeks ago. And it was one of those things. It's like, God, what? It's like the signal sort of said you had to, right? Like you got to trust the process. And I'm going like, it doesn't make sense always, right? And so I'm going like, okay, like all of a sudden I've got a trade on in bonds. I've got a trade on in the dollar. I'm really quite long gold in the portfolios. I'm still long silver. we're long miners, like we're long all these hard assets, and then all of a sudden it's like, oh, we're long the thing that should be working against that. And
Mm-hmm.
is that it's sort of like, okay, the math says and the process says to be that.
Mm-hmm.
But when you zoom out, is that the macro framework starting to hedge that risk? But
so that's the interesting thing, right? Is like we end up on a 15-day correlation basis. Your U.S. dollar correlated with gold is now a positive zero point 0.7.
yeah,
So although you front ran us by about 2 weeks, and by us I mean so I'm a I help manage an ETF through Hedgeye Asset Management. The ticker's HECA. And we put on the dollar position last week. So you front ran us by, so well done. Hat tip to you, Brandon. Hat tip to you. And so but we did that, to your point, right? We did that as like, okay, we saw kind of the volatility sort of spike, obviously, post Trump announcing the tariffs. And again, it's rooted in narratives and what have you. So you got to really look through that. And I'd kind of leave that as one of the biggest takeaways, if there are any from this conversation for those listening in. It's really block out the noise, right? Block out the noise, eliminate narratives and really kind of drill down on a process. It can be any variation of a process, but as long as you're consistent with it, and I know, Brandon, you very much are. But I'll get back to my point is that, we put on that dollar position as a potential kind of like hedge, right? As like, okay, like it's been going down, or to your point, and then through a few days later, it's actually now got a positive correlation. So it's not really working out the exact same way as what we thought, but it is still working.
Yeah, but like we saw a similar dynamic last year, right? Like where all of a sudden, like the dollar starts marching higher, and everyone's like, oh, it's the end of gold, right? Because gold had a pretty good listen, gold had a pretty good year last year too. And and it's like, man, this, okay, all right, dollar strengthening. This should be, this really should be the end for, stocks, and this should be the end for, gold run and all this stuff. And all of a sudden they're both going up together. And then what you saw, you never saw the gold really recede meaningfully. And then all of a sudden when you see the dollar dropping this year, then it's like gold goes on the run. I mean, like really, right? And so it's kind of one of those things. It's like, is the dollar going up right now potentially masking the run, right? Is that really buffering the acceleration of hard assets, and if so, is that providing the future runway for it, right? So if the dollar gets really strong again and then the dollar recedes, does that then kind of like take the brakes off and let hard assets, run again in a really meaningful way? I don't know. I don't know the future, but these are the things that I start to like wonder a little bit, just because I'm a nerd. When like when things aren't making sense, but the process is saying, do you know what I mean? You gotta be doing this.
It's interesting, Brandon, because if you look back and I just pulled up the gold chart, it kind of gold went relatively sideways most of the summer, like both basically kind of peaked in April.
It was like kind of painful. Like
peaked kind of end of April, right, and then sort of moved sideways until basically about the end of August. For all intents and purposes. So, from our perspective, it was actually like losing signal strength and really wasn't sure what it was going to do. And then just once it's basically seeing some flows at the end of the summer here in the US, right? End of August, beginning of September, it's just been off to the races. And And my question again, I know I just said, ignore the narratives, right? And I do. It doesn't mean I don't think about them, to your point, right? It's, but it doesn't necessarily influence my decision making or our decision making, right? Like our process is rooted on a quantum mental kind of structure, and so, but it's the question. I think this is a big one. Is what will the global central banks and really the kind of global like governments are any of them willing to basically work on their budget deficits, right?
Yeah.
And somehow reel in the money supply, because until that happens, you better be long assets, and they can be equity assets, it can be your real estate, it can be precious metals and kind of everything in between, but you better be able to kind of touch it to some capacity, right? And because you've got money chasing finite supply, And that's what we've been seeing. That's what we've been seeing really for the last, 2.5 years, ever since the Fed stopped raising rates, right at the end of 2022. We've really seen this sort of, okay, we kind of had a new normal with, again, I'll say elevated rates from prior, ZERP era, Brendan, as you know, right? But
it's not exactly elevated,
a 5% Fed rate is not going to kill anyone.
Well, if you go, if you've never had money and you get $5, it's like you feel rich,
Completely, right? And so again, it's almost like perpetuates the whole money supply dynamic, though, right? Is that you've got more assets, and those they're earning a better interest rate. So I think that's the big question. That's the big kind of big picture component for me that I'm thinking about. And when does that happen? And if so, what does that mean for kind of the things that we hold in our portfolio and potentially what you hold in yours?
Well, like let me narrow the playing field for you even a little bit further. Right, Rob? Because if you say like, well, our governments around the world, are any of them willing to do this, right? Are any of them willing to, control their spending, manage their taxation, right? Run a clean balance sheet, run a good program here, and you actually have to narrow that scope down in the lens that we're looking at as investors, because you have to say, are any of them that actually have a currency that could absorb the amount of capital needed? And that list is right, because on its face you look like, okay, Swiss franc. Right, like the Swiss franc has sort of always been this interesting thing, and that's why they're going back to, I think right now we're seeing like negative rates again, right, in Swiss franc. Mm-hmm. It's like, well, yeah, that's fine, but if all of a sudden you said, well, everyone wants Swiss franc, I mean, that's literally like you end up with the same problem of, and so I like live in St. George, Utah. That's like if everyone in the country wanted to move to St. George, Utah, every single person, mm-hmm. It's like, at a certain point, it doesn't work, right? If you're like a townhome costs, $35 million in St. George, Utah, because everyone wants to live there and they're willing to do whatever it takes to own that. It doesn't work. Mm-hmm. And that is one of the things that has given the US dollar its dominance, is the deep liquid capital markets that we have in the United States, and the petrodollar, everything being priced in dollars, oil's priced in dollars. Mm-hmm. And so there's really no other currencies. Like if you look at it through that lens and that framework, all of a sudden you say, okay, well, anyone that maybe was even a candidate for, maybe they could be prudent and maybe they have the political willpower to stick through that austerity and that discipline, they're too small. They're just candidly, they're too small. So if you're in a one-off trade and you're kind of that guy that's on the fringe saying like, hey, I think there's an opportunity set here, like you can be that, and it might turn out really good if you're early, but at the end of the day, like what people forget is, the big capital allocators, the huge endowment funds, the institutional investors, Wall Street in general, right? They're not dumb and naive. This is why they don't talk a lot about micro cap companies, because they know that at the end of the day, they can't go and allocate and they say, hey, we manage $1 trillion. We're going to go put, 1% of everyone's money in this $1 billion company. Well, that immediately makes it, probably a freaking $1 trillion company in and of itself from all the flows going in. They literally can't do it, right? So they have to look for things that are deep and liquid and can absorb a lot of capital. And I just don't really see that opportunity set being something outside of the US dollar. And what's really interesting is like gold is becoming, I think, really inelastic, and where you're seeing like gold faces the same issue that like Swiss franc sort of does. And like Bitcoin faces the same issue as well, right? Like there's just a finite amount. And at the end of the day, when you introduce the incentives of gold, I mean, I just don't, when's the last time you ran into somebody that has like really been in the gold trade for a couple of years even, and they say like, oh yeah, I'm planning on just selling all my gold once it hits 4,500. Like no one. I like seriously, people are like, oh no, you just like it'll never go down. Now, once everyone says it will never go down, that's probably a great top signal. Like once they say it on like once they're saying it on CNBC and Jim Cramer says like everyone should just own gold, it never goes down. That's like I'm selling,
Yeah. Merrill Lynch had me nervous the other day, because they're talking about putting 20, I think it was 20, maybe 25% of there. And I was like, oh shit.
And remember, hey, gold doesn't like pay a dividend. It doesn't return money to investors, right? Like, and so it has some of these same issues that Mike Green brought up about, Bitcoin. Like now there's some nuanced differences, right? Like there's all of a sudden the incentives to mine more gold, right? And figure out how to develop a new technology to solve that issue. But in the short term, right? If you take Merrill Lynch or Goldman Sachs or Morgan Stanley or these guys and they say, hey, we manage, I mean, what do those guys manage? I mean, like $1 trillion. I mean, these are like,
trillion, yeah.
You know what I mean? It's like, and they're like, we're going to put 20% of all the money. We're each going to put $200 billion in gold here. It's like, if you have $1 trillion go into gold here, and remember the incentive, like everyone's like, well, I'm not selling my gold, right? It's like an actual hard asset. All of a sudden the price gets like wildly stretched. And that's a really difficult thing about gold. I talked to somebody last week and they said, yeah, I really love the idea of gold. It's just gone on like such a run. I just can't do it, and it's one of those things. It's like, it's so hard because from a historical perspective, you're like, if you're viewing gold as a commodity, commodities die on high momentum, right? Like, right? Like the old commodity saying is like, nothing solves high prices like quite like high prices, And I think at the risk of being the guy that says like, this time's different, all I'm saying is I think we're going to potentially see the same dynamic in this particular period, or like in the near term of gold and silver, where things go to where people think they should top and then they go a lot further. And it's just because of the inelastic nature. Now the downside on that is, you might buy $4,000 gold today and it might go to 8,000. And at some point in the future, it might trade at 4,000 again, once kind of the inelasticity snaps back to reality. Like, I don't know how to fundamentally value gold. You really can't do it. It's like some people try to do it and they say, well, gold should trade here or there. But at the end of the day, it's really just dependent upon what are people willing to, pay you for it. And, the black swan, which you can never predict the black swan, right? Like that's the whole idea of like the black swan. But certainly if the U.S. came out and said, hey, we're going to do austerity and we're going to keep the government shut down and we'll just shut down all these, programs and we're going to do the austerity thing. Like we'll make sure that we collect the revenues, cut the spending, all that. Like I think gold, I mean, like if they really not just say it, but really do it, gold, that will be negative. That will be negative for the price action of gold. I just, when I pose that idea to people though, I generally just say like, so that's how it goes wrong. What's your confidence interval that Congress stops spending money?
Yeah,
I just like, because that's really what you have to sort of like ask is like, what's your, that's like what it comes down to.
There's a whole philosophical conversation here that we can go down, Brendan, which is like, we live in like literally almost everything that we touch is driven for us to consume, right? I mean, you just look at your iPhone, right? Like your iPhone is literally like almost every app is geared, there's advertising on it, even just the weather channel, right? The weather channel is not just like you go to it for the weather, but they even have a premium subscription, right? It's like, I'm not that big of a weather nerd, but apparently you get some cool stuff. So, it's like literally everything is geared towards consumerism. And the government, and really just like, so that same mentality in my mind, it gets sort of conveyed and relayed and really sort of, that's just the way that our government thinks, right? And our leaders sort of think, right? They can they've kicked the can down this road for so long. What's another kind of 2 years, right? To get them through the midterm elections, et cetera, et cetera. But, I think, to kind of tie it into our process, right? It's, we look at going back to kind of at the beginning of our conversation, it's the flows trump the fundamentals, right? And so even if we were looking at an environment where, from a estimated quad and like the back test, let's just say, right? And again, there's a lot of different factors that go into it, but just for kind of, layman's terms, if the back test on the quads was really negative for gold, but we're still seeing these all-time highs, I mean, that's why, we kind of have our system geared kind of 2/3 to 1/3. So 2/3 towards signals and flows and 1/3 into the fundamentals, because those flows can, luckily, they've kept us in this trade, right?
Yeah.
And we've had a really great, we launched our ETF on July 1st and really kind of rotated into these, some of the components that we've talked about, whether it be gold or silver and some of the miners. But, we rotated them into kind of like the end of August. So our timing ended up being quite quite good, and it has worked out for us. But it's also helped us stay in the trade, because if it was my former self, right? If this was 5 years ago before I really found a Hedgeye, I would have been, I probably would have been like, there's no way we can, we just hit peak on silver, right? We just surpassed, the all-time highs. And so this is where I'm going to kind of starting to reduce my position. And who knows? I'm not saying it's going to go up another, 50%, but, until you get that glimpse, right? Or that signal, right? From your process that says,
Yeah.
hey, you need to be reducing that size, right? You need to be, something's like changing here, whether it's like the volume's not there supporting the price action,
Yeah.
or volatility is starting to rise in conjunction with, increased volume and prices going lower. Those are the components where it's like, those are the red flags, right?
Yeah.
And so, but for right now, it's kind of all systems go, and we're continuing to ride that train alongside you.
Well, I think we're entering this period of market structure where everything is getting somewhat inelastic, and not many things are getting dislocated, right? But when elasticity corrects, it's going to be dislocated, right? And so what I try to tell people is like, hey, whatever your expectation of a max drawdown has been, right, in an investment,
maybe triple.
Yeah. Okay. Well, you're more conservative. I mean, I usually say like 1.5 to 2 times it, right? So like, and
I mean, like
but I generally say like, well, okay, like S&P 500 08 went down 54%. Like, hey, look, you better be okay if you're like, hey, I'm buy and hold the market no matter what, it always comes back. I've got a 35-year time horizon, blah, 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 blah. I still think you're generally somewhat foolish in that, because life happens in the midst of drawdowns, and it tends to happen the most during those big periods, right? The time you're most likely to have to liquidate your 401k to pay the mortgage is like in 08, right? And so drawdowns still are wildly detrimental, but you got to be probably okay and look yourself in the mirror today and say, I'm okay with 75% loss. If I have $100,000 in the S&P 500 today in my 401k, and I'm just, I'm okay buying and holding the market, I don't want to pay the cost. You really probably at some point need to be okay with a 75% drawdown. That drawdown will probably be short-lived, and I will concede that point, because I think the S&P 500, I joke at this point, it's like the public pension program. So at that point, the odds of the government stepping in, QE, print money, blah, 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 to bring markets back online is really, I think, quite high. But do you want to, just like what's your thought process in doing that? Because if you're going to get down to 60, 65% down and sell at the bottom at that point, you got to like, you don't want to be getting out at that point. You got to really ride the ship, right? Kind of like, the old saying, right? Too late to sell and too early to buy. It's going to be a really uncomfortable period at some point. And that is probably true though, right? For not just S&P 500, right? I'm not trying to sell people away from S&P 500 here or something. Like we've got a pretty good size on an S&P 500 right now, right? Like, but the same is true for silver, right? There's nothing to say that silver can't run up to 100 here or 200 here and then come back to 50. And actually, if you look at the confluence of markets, I really actually wouldn't even be surprised if it gets 100, 150 and it retraces all the way back to 50 at some point, and probably touches out on a big long, candle wick and then, rockets back off eventually. But like, man, like we saw that. We saw that in April.
Just look at, just on the commodity side, right? I mean, just look at cocoa last year, right? I mean, if you look at, cocoa futures, I mean, it was a beauty, right? In terms of just like, momentum and capital continuing to flow to it as it kept making new highs. And then to your point, it's not like the bottom completely fell out, but it's certainly, if you pull up a chart now, what it looked like over the course of the last 12 months, it's a drastically different picture today than it was, a year ago. And, I think, and again, like just to kind of reiterate your point, I mean, I think your flows go like kind of both ways, right? So like the acceleration factor is so much greater today in 2025 than it was even, again, 5 years ago, let alone 10 years ago, because you have a larger number of systematic flows that are in place, and they will react, and there is not a human pushing that button. And you saw the negative reaction on Friday, right? With Trump coming back out, bless you, with the Chinese tariff kind of announcement, right? And you saw that
Well,
harsh move down.
I mean, not even that. Look at what happened in crypto on Friday.
Completely.
I mean, auto liquidated. People had fortunes, wiped out because they got auto liquidated on their accounts. And I saw stuff where people are like, well, I even had a stop loss in place. And it's like, hey man, when markets are illiquid because that elasticity is correcting back.
Yeah.
It doesn't matter that you had a stop loss. You couldn't get filled at the level that you said you wanted to sell at. It went all the way down, completely wiped out. And
I mean, that's what happened. That's what happened with like crude oil, right? And during the pandemic, it went to negative. I mean, it did. It went to like a negative number.
Yeah,
because there was not a bid. Like, you literally had to pay somebody to take the oil from you.
Well, and like that's a world in which circuit breakers exist. Like in traditional financial markets, like circuit breakers exist. There's this element of your broker calls you and says, hey, can you send more money in so we don't have to liquidate you? Do you want to do that? You want to get liquidated, right? Like in crypto, I mean, I think it happened in like 3 or 5 minutes. It's like you had no chance. I mean, you could be sitting at your computer and you probably had no chance because by the time you went like, oh my gosh, you're like, if your immediate initial reaction wasn't liquidate right now, it went all the way down. I mean, and some of these coins just took like, I was 99% loss. And some of them recovered, like a huge bounce off the bottom, right? Like you somehow bottom tick that. I mean, you made a fortune, but it's so that's the inelasticity cuts both ways. And I think we're going to start seeing that in basically every market you're following, whether it's commodities markets, bond markets. I mean, like the distortion in high yield credit is really interesting right now. The equity markets, right? Everything. And so like, but the impact that has is when it goes wrong, however much you're expecting to probably lose or give back, you probably got to increase that expectation. And also in the same token, what you can expect to maybe make on the upside, you probably should increase as well, right? Like the thought that gold was going to go to, $3,500 an ounce this year was like, no one was really even calling for that last year. You know what I mean? And now it's breaking 4,000. And I don't know that it's done here. I mean, and people are, and the reason I don't think it's done is because people are all calling that it's oversold overbought. Right? I mean, there's like posts all over the place from people, oh my gosh, gold is so overbought. Gold's overextended. Gold's so expensive here. Gold is blah, 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 blah. And I'm like, yeah, but it's not selling off, which means it's probably just going to get worse. And I still don't have people like, it's like the old indicator, right? It's like when when grandma calls you up and asks about the stock, like that's probably when it's like, it's like people aren't calling and saying like, let's get more of this, like, hey, like, let's double down.
It was like November 2022 when you're at Thanksgiving and everyone's like, oh, like,
it's time to short the market.
I own Amazon since 2005. I mean, do you think I should sell it? And it was like literally the bottom.
Yeah. Well, it's like, there's something to be said about that. But I think essentially, again, going back to the inelasticity thing, like it goes both ways. And so
it does.
Be careful exiting too early, right? But also make sure that you're risk managing on the upside. And there's no, like, I generally am somebody that thinks markets can be timed by professionals. Like if you're a dentist, like you can't time markets. It's going to be really, really tough, like because you're being a dentist all day, But I think by professionals that are focused on it on a daily basis, markets can be timed, but not timed perfectly, right? Like I know I'm not going to top tick, a trade, and I know I'm not going to bottom tick it. It might happen every once in a while by coincidence, but even earlier this year, I actually top ticked gold and had sold gold like right at the top tick at late April. And then it pulled back and I ended up like, I was like, cool. And I actually bought back in. So I at the time I'm like, oh sweet. I top ticked gold. That's that's cool. It's like, and then it's like, okay, zoom out over at the end of summer. It's like, well, had I not also had the discipline to say like, but I'm sort of staying in the trade. It was just a tactical, sort of sell. But hey, now it's kind of a more favorable position to re-enter. All of a sudden, I would be like sitting here being like, man, I didn't top tick crap. It's like I only top ticked it because I got back in. Otherwise I just sold too early.
You're right. Exactly. Yeah. No, it's so true. That's where Yeah, I mean, again, I'll go back to kind of like a process, right? Like if you got a process in place, and I know you do, and certainly we do at Capital Allocation and the Hedgeye as a whole, that's the way that you can kind of navigate these markets and try
Yeah.
your best to, it's not going to be and every time is a winner, but you're increasing the probabilities, looking through that fractal lens, when you approach markets, and I think that's really our edge, and that's where that's what we kind of bring to the table, and I think we're doing a pretty good job so far.
Yeah. Yeah. Very cool.
Yep.
Well, I certainly appreciate the conversation.
No, thank you for having me.
Thanks,
It's been a pleasure.
Thanks for the thoughts. It's certainly a lot for people to be thinking about right now, and I think as much as the narrative has shifted away from, hey, just away from prudence, right, and just hey, just hold your nose, hit buy, always keep buying no matter what. I think that the prevalence of that idea is sort of the indicator that it's time to start being really risk managed.
Yep. No, so, I think it's like that static portfolio, right? Like that 60-40, to your point, right? Like the inelasticity, it's potentially going to like hurt even more the next time around, right? And so, having that dynamic asset allocation, that dynamic portfolio management, it's crucial in this day and age. It's absolutely crucial. And I know you're doing it on your side, and we're certainly trying to do our best on our side, but it's, I think it's definitely in my humble opinion, it's the wave of the future.
Yeah. Yeah, totally. So,
yeah.
Well, I appreciate it. Appreciate it, Robert. And
thank you.
We'll be seeing you around. Thanks.
Yes, absolutely.